I'm sitting here, not in person, but in a stuffy alcove in Aldridge Hall at Harvard Business School for my reunion. So I did, on some of the faculty presentations, not want to get edited out. And so when they asked the question of inflation, I said, one person asked me, who would you rather live under, Joe Biden or Jimmy Carter? And I said, well, that's easy for me, Jimmy Carter, because I was 40 years younger and 40 pounds lighter. So believe it or not, that one didn't get any objections. Everybody kind of roared on that one. So hopefully we'll be able to do the same thing here. You know, I did do some homework before this, Marty. I did ask my colleagues about what's going on in the world and what they thought about managers. Some of them, you know, there's only one billionaire that we had here at this time, at least in our 1970 class. But there's a lot of other guys, and they've got family officers or investment advisors. So I did ask them there, but and they basically said this. They said there is more ways to lose money today than before. There's things like NFTs, Bitcoin, and SPACs that can vaporize your money, and there's really no way to effectively hedge them. The other thing they said, there's a lot of complex leverage products, 2 or 3 times ETFs that, you know, they really don't understand, but you could whipsaw pretty quickly. And then they said, you know, there's things like wheat and corn and natural gas and stuff that you recommended, but, you know, unless the things keep going up at a rapid pace, that's hard to, you know, they have to continually sell futures, so you need a rapidly raising market. So that was some of the kinds of things. But they also said that, hey, you know, if you look at, there hasn't been a bear market since at least 2008, or anything that's lasted more than, you know, a few days or a few weeks or months. So they said, don't talk to anybody that's, you know, under 40 years old, because, you know, say the guy graduated in 2008, you know, he's got to be at least 24 then. And so he's probably around 38 to 40, depending on whether he worked before that. So that's kind of the things that I learned, you know, so far. So what I think I'll do is have each person give a couple-minute summary of their stuff, and then talk a little bit about some of the introductions of how they choose managers. I'm gonna after I give my short intro, I'm gonna let Denise, Diane Wang speak first, because she is got a tight schedule. So my name is Gary Sawka. I'm great to be here, even though I'm not here in person. Well, I'm here in person, but I'm not in person with you. And, you know, I've been on the board of public and private companies for many years. Before that, CEO and CFO, but mostly CFO. And the latest thing is that we've got something called Digital Solid State Propulsion, an Incatel funded company. 2 very important things. Number one, it's providing the propellants for Cirque du Soleil Mad Apple at New York Casino. Opened up a couple weeks ago, so hopefully you guys get to see some fireworks there. And number 2, they've got a contract with the U.S. Army for battlefield effects replicator for urban warfare training. Hopefully, we won't be using urban warfare here or in Kiev or wherever they may be. But anyways, the U.S. Army bought a big multi-year contract for that. So that's about the amount that I have in time. So I'll let Ms. Wang start off first with a quick summary of her business, and then some comments on manager selection.
Thanks, Gary. Thanks, Marty. Great to be on this panel. I just realized there's some echo here. I just arrived in my Austin hotel, being here next couple of days for consensus, which is part of the reason I probably need to leave a little bit early, but I'll try to stay as much as I can. My name is Danye Wang. I'm based in New York. Grew up in China, actually, and came to the States for college, and then spent most of my career with BlackRock. Everybody knows the largest asset manager in the world. And I was in an institutional sales role with the firm at the time, managing a lot of the sovereign wealth fund, central bank, large insurance companies relationship globally, and then launched and run one of the largest institutional training program in the industry, known is BlackRock Educational Academy. The program is still around after I left the firm, so I was very proud that over thousands of institutional investors have attended this program over the years, topic of asset allocation, risk management, different asset classes, including alternatives. And then I started my current firm, UniGlobe Capital, about 3.5 years ago. In the beginning, it was a cross-border advisory, mostly working with Asian-based fund managers, predominantly venture capital, selectively hedge fund as well, on cross-border deals and helping them to tap into global LP base, including endowment foundations, and as well as a lot of family offices. And through my work doing that, I built very strong relationship with some of the largest and most prestigious Asian family offices, China, Hong Kong, Singapore, Indonesia. And given we all know what happened in the last 2 years, COVID, trade war, and some uncertainties with political dynamics and policy risks in China, specifically a lot of the ultra high net worths and large families behind the conglomerate across different industries, manufacturing, tech, and real estate, really started globally diversifying their asset class. And some of you might have dealt with Asian family offices, especially those from China over the years. And this wave of asset allocation, especially in North America, is different from, say, 4 or 5 years or even previously, because of the return expectations of these families have came down substantially given what is happening domestically. And most of the families have hired professional returnees who are well-trained internationally to be their CIOs or head of public markets, head of private markets. And they leverage people like me who are really plugged into the local venture, growth equity, and today even like crypto Web3 ecosystem to be their overseas conduit when it comes to manager selection. I'm happy to go into some of my philosophy and what I'm looking for these days, but maybe I'll let the other folks do a quick intro before I get into that.
Yeah, so I'm going to call on people in the order that I see them on the screen. Luis, you look like you got the headphones on and ready to go. So why don't you take it from here?
Yeah, so interestingly, Blake Singer, who's also on our panel, is we work together. So my name is Luis Medina. I am the Chief Investment Officer of Helix Capital Group, which is a private investment company. I also am contracted with an SEC registered investment advisory to work with their wealth management team, and I also head up their investment strategy. Have built out alongside Blake, have built out their alternatives investment platform, and then also with a separate firm.
Looks like you're frozen up, Luis, but or got mustache freeze.
Well, maybe I will pause my video and continue with audio for a little bit. How does that work? Am I clear with audio?
You were clear with me.
Okay, so and then we also work with a broker dealer, multinational broker dealer that we've also worked to build out a platform, source and vet ideas on the venture capital side. You know, with respect to the range of types of things that we've looked at various fund managers in both the public and private market side. Private equity, venture capital, real assets, infrastructure, digital assets, as well as individual co-investment deals alongside, top tier prestigious managers, whether in the venture capital, private equity, or real asset space. I'll pause there. Gary, was there other things that you wanted me to highlight beyond the?
I think that's good. My apologies for some of the background noise because I thought I had a quiet cubicle. I'm only on the second floor of Aldrich. I should have went up to the third, and unfortunately, they have a faculty presentation. Some guy here keeps going back and forth for water, and it looks like he's looking for the restroom. So I don't know, but I apologize for that. No, I think that's enough for the next go round. I think we want to go through one round and then let Danya talk again. So Mark, you look like you're ready to go. Put your mic on and you can you can start.
Gary, hi, it's Blake.
Oh, Blake, I'm sorry. You know what happens? There's two other people here, Mark and Robert, but I don't think they're on the panel. Okay, my mistake.
I've been called a lot worse.
You got blanked out, huh?
I've been called a lot worse, so Mark is a compliment. So hi, I'm Blake Singer, and Marty, thanks for putting this together. As always, it's interesting, eclectic, and I always come away surprised at just how much I get out of your forums. I am a managing director at a broker dealer, a small broker dealer called Amera Securities. Amera Securities, the firm raises capital for emerging technology, biotech, and some natural resources companies. And I also, with Luis, work with a registered investment advisory firm called CMG Capital Management in Pennsylvania. And we kind of act as outsourced or insourced, if you will, investment officers. And we've kind of built out their wealth management platform. Prior to moving out from Portland, Oregon, I live in New York, in the Hudson Valley. I started my career at Merrill and was in the asset management group at Smith Barney, and left and started a traditional investment advisory firm in '94. And we started our first hedge fund in '99. And we actually were Smith Barney's very first prime brokerage client, which was interesting. Talk about being on the bleeding edge rather than the leading edge, but it was a good relationship. And that hedge fund grew to a point where we sold the traditional wealth management firm that we were running. It was a stat arb strategy and had quite institutional clients and a life insurance, Deutsche Bank, Cargill, et cetera, et cetera. And it was about a $400 million fund. When the ARB went away, we closed it down. We started a few other funds, volatility arbitrage fund and a fund of funds, back when they used to have fund of funds. So we allocated capital as well. I then started a commodity trading firm in the mid 2000s. We had offices in Sao Paulo, Brazil, and Pretoria, South Africa, and worked for a family office before I moved out here to work with Luis. I met Luis, interestingly enough. Luis was, we met on LinkedIn, and Luis was a decade ago, and Luis was working on his PhD at University of Pennsylvania. He had gone to Brown as an undergraduate, and we met on LinkedIn and began to collaborate on a equity long market neutral fund, which thankfully never took off. But we kept in touch for over a decade, and now work together as a team. And we are launching a service that basically does what we've already done, which is provide kind of outsourced chief investment office services for family offices, ideas or full portfolios, or to registered investment advisories that are looking to get into and understand alternatives. So I'll leave it at that.
Please share information about that with me.
Absolutely. Absolutely.
So I think the most important thing, I guess, is you've got a family to report to, along with hiring a manager. So there was a great panel before us with Mark, and they talked about expectations going down. So I don't know I guess it's only important about manager selection. If you like your manager, it doesn't really make any difference. They're doing a good job. But if you were looking at so that would make a short, first round. But if we say we are looking at other managers for some or all of it, what do you have to convey to the manager about your return expectations in the next few years, as well as what kind of products they want, and you need them over 40 years old, because they've never seen a bear market before. So Danya, why don't we start with you first? And then we'll, because, we may not go through all these rounds. And so let's start with you, and then we'll go to Luis and then Blake.
Yeah, really good question, Gary. I think given what has happened in the public markets in recent months, there's obviously a trickle-down effect to growth equity, but also to early stage venture as well, coupled with the level of education someone like me to do with families, because a lot of these communication are done cross-border. Most of my work are concentrated in venture capital across 5 main different sectors: consumer, enterprise, healthcare, deep tech, and the 5th category is crypto, Web3. I do selectively look at real estate and private credit as well, but typically, even if the family is interested in those sectors, sometimes they would go through a more dedicated advisor focusing on that specific alternative vehicle. So my expertise is really more on venture growth equity. I think from an education perspective, it is obviously important for me to communicate given the life cycle of the economy, given what I've seen in the market, through constant communication with existing GP relationship, newer GP relationship, across the board with other institutional investors, other family offices, what kind of market intel I can gather. From a return expectation perspective, part of it is managing expectation, but especially in the sector of venture capital, it's a long-term game. So I don't necessarily worry about return profile and whether or not the managers will be able to deliver the return profile if I have done my due diligence in terms of understanding their team, their strategy, whether or not they're disciplined when it comes to valuation, how do they deal source, what exactly is their value add, have the team or at least the partners of the GP has been through economic cycles to know how to handle some of the economic downturn. And also reference calls, especially when it comes to conversation with their existing portfolio companies, some of the founders that they have backed before, or even founders that they chose not to back. So a lot of work that would go into the screening process before I even present the managers in front of the families. The return expectation question is more about, are the families comfortable with at least a 8 to 10 year lockup? And is the manager I put in front of them a top quartile manager? People should come into these arrangements knowing that the capital is locked up for the long term, and the risks they're taking should compensate the return profile that they will be getting. Actually, early on this year, I was also interested in the private credit investment. In the last panel, we actually spent a lot of time talking about secondary or even distressed special situation transactions. Some of those opportunities I personally really believe in if the manager had the right skill set to work out those distress situations and also acquire certain asset at a hugely discount pricing. I think these are substantial opportunities, but sometimes it's also challenging to communicate to the family offices in Asia because they're not necessarily familiar with the asset class. The family offices from Asia are most familiar with the asset class of real estate, public equity, as well as venture capital. So my focus on venture capital is partly resulted from their starting point in terms of the risk appetite and their familiarity with certain asset classes. So I guess in general, there were even without the economic downturn, I think I have a keen focus on emerging managers, although my definition of emerging manager is more like mature investors capabilities and deep sector insight, although the investment vehicle or the fund vehicle could be new. And obviously you have to evaluate the team, whether or not the full team is a spin-off from a previous fund, or the 2 or 3 partners have worked together in terms of deals, or at least interacted in different transactions previously, because I've seen a lot of emerging managers, they look great on paper, but they just couldn't really reach conclusions because the chemistry and the decision-making process of the partners on top of the management just can't sync up. So I spent a lot of time going to conferences and also cross-reference with other GPs, fund of funds, as well as US family offices to compare notes in terms of knowing what kind of newer managers are on the pipeline. But in terms of actually doing due diligence, obviously there's a lot of work behind the scene, and also making sure that people can be truly aligned. The family offices I represent care a lot about GP commitment, how much capital essentially it's the GP, especially when it comes to emerging managers, how much capital that they are willing to put down as partners of the fund, and especially this time around versus any other time, being very disciplined and sticking to your strategy, actually having a strategy, having a unique skill set and unique value add is so much more important than just pursuing hot deals. And I think going forward, I will stick to that strategy, and always happy to compare notes with other like-minded investors as well on that.
Well, that was a great summary. That's fantastic. Actually, I talked to one of my section mates, and he was unloading some real estate. The big thing he said is, what's going to be the cap rate when I buy a project? What do I assume for the cap rate? And he said he just unloaded a big chunk of storage units in Texas. Somebody gave with a 3% cap rate. So that guy's obviously got a pretty bullish expectation, maybe a little bit more than mine, maybe a lot more than mine. So, okay, Luis, go ahead. You're next. That was
hey, so I'm currently trying to fix an audio issue on the microphone. Let's let Blake go, and then I'll speak after Blake.
Okay, great. Go ahead, Blake.
Thanks, Gary. So the question was sourcing managers and what expectations we might place on the managers we source, and also the expectations that we might convey to our clients based on those managers. And I would say in general, Luis, we really approach this, and Luis is more opportunistic than I am, but we approach this as investors rather than allocators. So in the previous panel, the gentleman aptly, there was discussion about the rising valuations in private equity, and the rising, or some concerns that are certainly prevalent in private credit, et cetera, et cetera. And that's not to suggest that all private equity and all private credit are bad places to be, even though those asset classes have swelled dramatically. So we're investors. We look for businesses, we look for managers and strategies that have a real moat around their business, and a defendable moat, obviously, and hopefully a profitable moat, and something that's unique. I'll give you an example. On the credit side, we and Gary, you'll like this, I guess. We worked with a manager whose group came out of Harvard Management Company. They ran the credit side of the business and had been there for quite a few years. And when they spun out, they launched their own firm, Harvard Management Company. This is the organization that manages Harvard's endowment. Seeded them with about 300 million. They have about 2 billion, 2.5 billion today. They primarily do higher yield supply chain and trade finance. So it's a very niche area. That basic business yields around 9%, 8%, depending upon the credit, depending upon, it's very short-term maturity. It could be factoring, it could be receivables, obviously factoring. It could be inventory, supply chain, credit. What they also do, and this is something they started while at Harvard, is they were approached by a group to basically write insurance on behalf of vendors selling to distressed corporations. So if you have a jeans manufacturer in San Diego that is got a third of their business that goes to Macy's. Macy's is a distressed credit. They want insurance on their receivables that they have outstanding to Macy's. This particular firm writes that credit default insurance, if you will. It's very short term. There's nobody else that does it. And they generate, returns that are probably 100 basis points a month. And the two combined, they've got a very small portfolio, less than $100 million that we participated in, that has expected returns net of fees in the 15 to 20% range. That's a real moat around their business. That's very unique. They truly understand the distress side of the credit. And I'm less concerned about a manager like that because they're not exposed to the entire swath of private credit or the entire swath of elevated values in, say, late stage venture capital. So we look for businesses, we look for moats, we look for niche strategies. Sometimes these strategies are capacity constrained, so we couldn't add too much value to Harvard Management that has 52 billion, but we can add a lot of value to a family with a couple $100 million or an RA with a couple of billion. We also, within certain, within more named area, more categories like private equity, which I happen to like a lot, based on the fact that they are, while they're purchasing companies that are still more valued than they were a decade ago, are less valued than the public markets, at least today. They also deploy capital in a way that allows them to have a more of a material impact on the future of that company. And so in terms of private equity, for example, we use a firm that has about 50% of their allocations to other managers that are in secondaries. So we're only paying the fee on about half of the portfolio to the private equity firm. And it's a very inexpensive way of getting access to some of the top tier private equity managers. So secondaries is another example and another way to access a market that we like, that has, like anything else, run up. I would completely agree with Marty that looking forward, distressed is going to be an area that is going to provide some amazing opportunities. And the great thing about this business with bear markets is they provide what Buffett might call fat pitches. And if we can find fat pitches when they become available and our clients have capital that has been preserved going into those periods of time, it's a lot of fun and there's a lot of opportunity. And I think, again, I would agree that distressed, while we're not there yet, there will be some amazing opportunities. So
I'm sorry, Blake, I just want to interrupt for 1 second. So can you talk about secondaries? So investing in secondaries, do you want to buy an LP stake in a fund, or do you want to buy a stake where you can, kind of pick from what companies you're buying out of that fund, right? So do I want to buy a portfolio of secondaries, or do I want to try to go to the fund and say, look, I'll buy interest in these 3 companies?
Right. So we're not in a position. We are not in a position to go out and participate in individual secondaries. So we would look for either a fund that does secondary / co-investments, and I'm really meaning more towards co-investments in that regard, where a private equity firm brings in some of their LPs to co-invest without fees, or those firms need follow-on financing and they provide secondary financing to their LPs. The secondaries that you were describing, which is buying out LP interests, I don't think we're there yet, but those are incredible opportunities when they come available. I just don't think we've seen the quote blood in the streets yet to see a lot of those committed capital or actually even selling out LP interests available yet, but it's coming, or it will come at some point.
Great. All right. I'm sorry, we have a question from the audience. Sal, why don't you, I'll repeat what you said.
Just ask him, what do you think the catalyst is going to be for those LPs to become available?
Right. So, I mean, just getting back to like, there's a lot of stuff happening privately that nobody's hearing about, whether it's, these China, Russian people investing in venture capital who are selling out their stakes now on secondary markets and whatever else that we haven't heard yet. So what's going to be the catalyst that makes this public or widespread? Any thoughts on that?
Here's one thought that this is just, and I'm thinking about this as we speak, but there has been the proliferation of and the democratization of alternative investments being marketed to high net worth individuals. And I think that's a really good trend. And that's a byproduct of the Jobs Act under the Biden administration that also created crowdsourcing or crowdfunding. The back end of that, I believe at some point, may be an opportunity where some of these high net worth investors realize that, yes, they were guaranteed quarterly liquidity on some of these fintech aggregator platforms, but when the proverbial stuff hits the fan, those underlying portfolios, which are not liquid on a quarterly basis, nor are the underlying investments quarterly liquidity, they're going to gate those, and there will be an opportunity to buy and provide liquidity to some of those areas. Now, this is speculation, and that might require creating a company that does proxy solicitations. But I'm just looking down the road, and in the late 80s, a lot of the broker dealers created these crazy limited partnerships for their high net worth investors. They were terrible investments. They were fantastic investments to buy in the secondary market. So that could be an area of where expectations of individual investors or high net worth don't match the realities of the current market, and that might provide an opportunity.
Yeah, this is really interesting because we got smart people here. So Lewis has a PhD and Danye went to Yale, and so I imagine that they're smart. But what's interesting is I've never done a study of whether or not the secondaries were better investments in 2008 to 2010, or if the vintage VC funds or private equity funds from that era were better investments. I don't know. Maybe they know, but that's actually a big question to ask because a lot of VCs are coming to me and saying, this is great. Everybody's repricing because Google and Facebook, who are the main acquirers, are down, right? So if you guys have any thoughts on that from a manager selection point of view, maybe you can give your perspective.
Luis, any thoughts?
Yeah, I'm actually about to pull up a slide that highlights exactly
I think Steve
what we're
Farrell is
talking
referring
about.
to it exactly the exact same thing. Yeah. Thanks, Steve, for the comment.
So while he's pulling up the slide, Marty, I have a friend as an example, and he would buy these private placement partnerships on a regular basis. A lot of times when they got so distressed in things like oil and gas, which went through bad cycles, these are years and years ago. And what happened is there's an estate sale, kids want all the money right away. And so what happens is that he'd get some real good discounts. But he said, I'm a guy that will listen to every one of those things that the guy who's selling them, because there's some wholesaler guy. So he got access. So it seems like you've not only got access to big things, but small things. I heard a guy here, he was in a state sale too. And this kind of funny thing, but he actually was looking for a safe cracker because he has a whole bunch of stuff in a safe he wanted to keep the safe as an heirloom, but they couldn't find a combination. So, I mean, I guess there's opportunities, sort of like doing what Geraldo Rivera did, break into the, you know, the vault that they had for, you know, who was it? The Alcalde. But there's lots of little things if you find. It seems like there's guys in the 60th and the 70th reunion, which are obviously in the 80s and 90s. Maybe they're a fertile ground to get rid of some of the stuff they didn't even know they had. But the kids, it seems like the kids, if they want something quickly, that's a good opportunity.
Perfect. Great.
Okay, here's a good one. Glad it's a good slide there.
So this is a very meaningful slide because when folks are thinking about private equity, they generally think about private equity in the context of traditional equity in the way that we understand and perceive them in the publicly listed markets. Here's an index. Now this is inclusive of primaries, secondaries. I don't recall if VC is inclusive of this. But what you see over here, over a nearly 30-year track record, right, of the private equity funds that have been in this index, is that for the most part, private equity is positive, even during some of the rough years, right? So you have the U.S. recession, you have the .com bubble, you have the great financial crisis, and what's really meaningful here are the upper quartile and the medians, right? So if you look at the median performance of the index and you look at where they've performed over time, whether primaries, secondaries, or even in venture capital, what I would expect out of venture capital is the dispersion to be greater, with respect to the firms, than in kind of a broad private equity index. And what you would probably see is but these upper quartiles, and some of the funds that Danya said she was looking at were, these are the flagship funds, whether they're smaller niche, managers and that are not broadly diversified. Maybe they're tech focused or industrial focused, or and then also you got the Apollos and the Clear Lakes, the Veritas, the Pantheons, the Blackstones, and so these guys are demonstrating. And the way I look at private equity, frankly, is that over their investment cycle, they're an absolute return vehicle, right? And that's how it's different than traditional publicly listed equity. You're going to see private equity get slaughtered like you did in the .com bust or in the great financial crisis, or late 80s and 2020. Private equity investors are not going to have the same mark-to-market volatility. It doesn't mean that they're not going to have down years. As we can see, there are some years where even the index were negative. But generally speaking, on the vintage years, on the call it the upper half of the private equity funds that would fall under the Thompson 1 index, frankly, with exception of 1 year, through 2017, and frankly, I would expect the same thing in 2018 through year to date. They're positive, right? And so with respect to the secondaries market, what I would, let me talk about VC, 2008 to 2009, I can't talk about what their specific unrealized performance was then, but if you look at some flagship, venture capital firms or fund of venture capital firms like Knightsbridge, that had an 07 and an 08 vintage in two separate funds, the realized returns on those were in the mid-teens, even though their first investment was made at a peak in the market. And then if you look at in firms like that with their performance in between and firms of that caliber, you're particularly when there's decreasing rates, which we saw here, then you're seeing really outsized returns in the venture capital market. Secondaries, at least during this period of the data that I've looked at, secondaries and primaries that have launched here, they're probably, in the, mid-performing 5 to 12% returns, and on the flagships, they're exactly what you would see on this graph. So, With respect to manager selection and identifying, this is talking about specifically in private equity, what you want to do is identify the funds that have a solid, repeatable process, and a lot along the lines of a lot of the things that Danye, commented on in how she's looking at them. Is it a sustainable process? Is it repeatable? Do they have a rigorous, process for, sourcing deal flow and looking at transactions? And if you're looking at the top fund managers, one would expect, even in our current market cycle for, where we are in today, I actually am very bullish in the private equity and venture capital space. Sure, there's going to be a short and intermediate term correction in valuations for VC funds, and that would impact, on some of the portfolio companies. But to deploy capital in a fund that's raising capital for VC or even private, certain private equity funds, what a great time to be, to start getting exposure into private markets, to then, have a, 3 to 6 year window in an investment period, to then have another, 7 to 10 year, or, some of the longer term managers, 15 years, to be able to have that capital be invested during that time. So while folks may be shunning away from private equity, obviously selecting the fund manager that's driven by the thesis that you have of the markets to meet that private market opportunity. What I just showed you was 30 years across different market environments. Some where the world thought the economy was going to collapse and the financial markets were going to collapse.
Louis,
so I'll pause there.
Louis, it's a great chart. There's no doubt about it, but there's a flaw in it, right? Which is that it's not weighted average. So
Correct.
Private equity is 10 times bigger than it was in 2008. So we don't know how it's going to perform. It's very much like a hedge fund. Some hedge funds do great when they've got $100 million under management. They get to $1 billion and they suck worse than the market, right? So we don't know what's going to happen yet. But again, a couple of the questions are this: dry powder, right? Do you have dry powder to invest, and or also the vintage, which you really didn't address the vintage issue, right? Again, it's a great chart. I would love to see that on with a weighted average background and how vintage funds perform by year, right? So if I can get into the best top decile fund, if it's open and I can get into it this year, that's probably a great deal. Is it open? Are they going to take somebody like me? Is there a great secondary, deal where I can get something at 50% discount? There's going to be a lot of pension funds. Actually, it's exactly what Ken Fryer said, which is there'll be a lot of people divesting because they need liquidity of their private investments, right? So that's where I'm coming from with regards to distressed and secondaries.
Yeah, so distress is another area that we've identified a couple of managers that we do like as well. With respect to the weighted averages, I will tell you at least what the data that I've looked at. The weighted average, the larger funds have greater firepower to be able to capitalize in our current environment. So what you'll find is that larger funds, not exclusively, there's some smaller funds, and this is not respective of venture capital. What's unique about venture capital is some of the smaller funds tend to outperform the larger, billion-dollar shops. Whereas in private equity, it's the opposite. When you're looking at secondaries, for example, you're going to find that the larger secondaries tend to outperform the smaller, on a weighted average.
Right. So unlike 2008 and 2009, where there's only like 4 big secondary funds, there's a dozen today that are all billion-dollar plus secondary funds out there. So there's a lot of money looking for deals, et cetera. So, but another question from the audience. I'm sorry, did you?
It was just a comment. If you could adjust the sound of this coming through, it's hard to follow.
Yeah, I know. Lewis's sound is a little bit garbled, but he's working with it. So
yeah.
But very fast. So we got 5 minutes, guys. Keep on going.
Can I add something here?
Please.
Yeah, I think that was a really interesting discussion. what I have noticed is that for the funds that have finished their fundraising towards the end of last year and very aggressively started deploying capital are all kind of in trouble situation right now. For the funds that continue to raise or have just about to wrap up their fundraising, or they have already wrapped up their fundraising, but left a lot of dry powder and have been very disciplined about how they call their capital, the next year or two are going to be great time for them.
Yep.
So I do think vintage year matter. I also want to stress on the changing dynamics of valuation, diversification, and exit. I think from a family office perspective, I wanted to direct deals as well, but sometimes I just don't have the bandwidth and don't always have the specific expertise required to evaluate deal by deal. So I think when it comes to the current timing and this vintage year and maybe 2023 vintage year as well, valuation has came down significantly, and it's changing tides, right? Great negotiation power kind of come back to investors, both from an LP perspective and the GP perspective. And also, I think diversification is key. So from where I sit, or from where the family offices sit, how do we know that the specific deals we're getting into, be it sourced from another family or even a previous GP relationship, how do I know this is a specific deal that will be a home run in the next 5 to 10 years? I would rather, to be honest, pay my standard management or carry fees, but let the VC do their job, and they can screen thousands of deals per year and identify the 40, 50 deals that they really want to get into based on their expertise and the sufficient time spent on that. Diversification is really key given market dynamics like this, because I think there are going to be some really, really good funds with a lot of home runs for this, for 2022 or 2023 vintage year. There could also be worse scenarios. Right? So diversification is key. And finally, I think from an exit perspective, I read a data that 90% of the VC exit since 2019 has been IPOs. Although we all know for all the IPOs that went on, especially VC-backed companies in 2021, most of them are underwater, significantly underwater from their IPO prices. So going forward, the IPO as an exit strategy is probably going to be relatively limiting. So the M&A market, corporate acquisition, secondary, et cetera, are all gonna, be part of the consideration when a GP or a family office think about exit strategy for any of their portfolio companies. So I would, when it comes to manager selection or even evaluating specific deals, I will always think about exit strategies or what are the scenarios that might play out, and specifically align with managers who have the skill set of not just running IPOs, but also additional kinds of acquisition.
So I just want to jump in here one more second and get some more commentary. So again, I speak to fund managers all the time. One of the hardest things that the most innovative fund managers are not large fund managers, right? So you've got guys who are coming out of like Goldman Sachs, Morgan Stanley. They traded foreign debt, and they underwrote debt to companies. Well, as I said before, the Fed is pulling back on dollars that are available. That's going to be pulled back all around the world. All these loans are dollar denominated. And I've got half a dozen guys who are like, there's a Turkey fund because Turkey's collapsing. There's a South America fund, South American corporate debt fund, the European debt fund. All these guys are raising capital. 5 out of 6 of them are not people who are, they had a fund before. It's a first time fund, right? So I think that today, understanding the opportunity and then also understanding this kind of, what's the credibility of the person who's raising. It's bigger problem than ever before, and maybe you guys can comment on that. How do you measure, what's at stake and who to invest in?
So
we have 3 minutes.
Yeah, real quickly, just to comment. I've had some turkey funds personally, not in the country, but I'll just give you an example of something that I think you're talking. Well, an example. There was a fund that I absolutely love, and this group came out of Goldman, just basically a handful of bulge bracket banks, and they ran an area within those banks called they basically, it was financial credit or providing credit to financial corporations in very unique, I wouldn't call it distressed, but regulatory finance, if you will. So if Santander, which is a Spanish bank, has a really prolific group of bankers in London that have created a huge niche for them in financing healthcare. And there are regulatory changes, cross-border regulatory changes that require Santander to get rid of that large portfolio. There are very few, and it's not distressed in the fact that the underlying credits are distressed. It's distressed in that Santander, as an example, needs to get rid of it off their books for regulatory reasons. There are a handful of groups that do regulatory finance that can buy these really amazing loan portfolios at discounts for reasons that have nothing to do with the underlying credits. And it kind of goes in line a little bit, Marty, with what you were talking about in terms of various countries. This is agnostic to country, but it relies upon a function in the regulatory environment, whatever that might be, that creates opportunity. And again, I'll just close. It goes back to looking at businesses and looking at companies or managers with moats around their businesses rather than the entire private credit. This particular group has a real moat around their business. They have their expertise, and they're going to get that call from Santander or from whomever in a regulatory change. That creates opportunity. Luis, any thoughts? Or
Closing
sorry,
comments,
Gary.
guys. Luis?
Yeah, no, Blake did a great job at talking about it. A U.S., not a U.S., a global special situations fund manager that we particularly like and think can, hit in particular unique areas. We also like a distressed manager who has a track record of, during the pandemic, when mortgage-backed securities dropped to, 40 to 60 cents on the dollar, these guys were able to assess nearly 700 of them, over the course of a weekend and put $500 million to work, able to hold those to maturity. And they made nearly 100% returns on those securities during a distressed, or what was a perceived distressed environment. Those are the types of firms that we like to work with. We have them in our arsenal. There are a number of other cases where they've taken opportunities, such as that, to execute value for their investors. But ultimately, as part of the manager selection, we want for organizations to have a track record, have experience, be a little jaded. Some folks that we look at that came out of Lehman Brothers, so some of our clients would ask, like, well, those guys, they were, anecdotally, they would say those guys were part of the collapse of the financial system. And I would say, those guys that we work with learned lessons that they'll never forget moving forward. So we like the weathered and seasoned individuals. And even on the emerging manager side, folks that have a track record in their background of being able to drive, whether it's operationally, investments, or process that can integrate in what they're doing on the investment side. So I'll close there.
Danya?
Okay, who else?
Yes, I want to just very quickly to put things in perspective. I want to give two quick examples in terms of how to evaluate the emerging manager. I recently invested in a Silicon Valley-based manager called GFT, and part of the reason I became a strong, developed a high conviction to their fund is the two partners. One used to launch Samsung Ventures in the U.S. The other was a corporate strategy head for NVIDIA. And the two biggest areas they invest in are blockchain and artificial intelligence. And both of them have a demonstrated track record on both. And both of them have spent 20 years of their time in Silicon Valley. Although they haven't run the funds together before, they've done transactions together and they've personally been friends for 20 years. That's one. And another example, I'm still in the process of evaluating, So I can't reveal the name of the fund, but it's a crypto Web3 venture fund. And I look for unfair advantage for emerging managers who not necessarily have a strong existing track record. But this manager was able to partner with Animoca as well as Sandbox, the CEO and co-founder of Sandbox, and together 4 of them became the GP. And this particular partner was willing to give up GP interest to Animoca and Sandbox to get a very strong leverage in terms of what they can offer to entrepreneurs in the Web3 space. So every entrepreneur would want them to be on the cap table because they're not competing with anyone else. They're actually offering tremendous value, just given how they have lined up their GP interest. And the final thing I want to say, if you guys are emerging managers out there in the audience, if you are raising a first-time fund and if you have never had a track record before, please, as you're raising, start deploying capital. As a family office, I would rather come in once I've seen you have raised, say, 20, 30% of your target fund, as well as you started deploying to 3-4 deals. So at least I can evaluate your skill set and your capabilities based on the deals you have already done in the fund that you're in the process of raising. So that's my tiny suggestion. Thank you.
Well, great job. And Gary,
Well said.
enjoy your reunion at Harvard. It's
Yeah,
probably your first
I
one in a
will
couple of
say-
years.
Yeah, so we'll be back again because it's a 2-year delayed, but I would say one comment, Marty,
Yes.
that in the future, I think I'd add, at the future conference, I'd add agricultural commodities. You know, before Christmas, we had a lot of people come to our house because we have like 3 Christmas trees. And I had a big roadmap I had bought of the Ukraine. And I showed people, I says, here's where the wheat's growing, here's where the corn's growing, here's where the wheat's growing, here's how the natural gas goes. And one guy says, you mean corn like corn on the cob? Well, he came by and saw me a couple of days ago. He says, you know how much money I would have made if I would have taken your bet that if the invasion of Ukraine happened. So there's a lot of stuff there. There's a lot of stuff in nat gas if we have a cold winter, because there's just no supply. You know, it's hard to move it around without a pipeline. And so I think that's a topic that would be good. We talked about a lot of great topics, but in the future,